Now let's take a look at accounting for whenever we return merchandise. On March 7th, ABC Company purchased $1,000 of merchandise on credit. The terms were 5, 10, and 30. Again, those are the discount terms. On March 9th, ABC Company returned $100 of merchandise because it was defective. And then on March 17th, ABC Company paid the balance due on an invoice. So let's take a look at see how we would record this. You know that on March 7th, when you purchase it, you are going to debit your inventory account for $1,000, and then you're going to credit your accounts payable for $1,000. Then on March 9th, we returned $100 of merchandise because it was defective. That $100 of merchandise we returned will reduce the amount of inventory we have by $100. In the same way, it will also reduce the amount that we owe our vendor by $100. So what we're going to do is we're going to credit inventory for $100 and debit accounts payable for $100. Then on March 17th, we pay the balance due on the invoice. Now, the first question is, are we within our discount period? Let's take a look at our discount terms. 5, 10, and 30, which means we receive a 5% discount if we pay within 10 days, or else the balance is due within 30 days. What is 10 days from the date of purchase? So we purchased on the 7th, we add 10, that would be 17. When are we paying? On the 17th, so we're still within our discount period. So we will get the 5% discount. But keep in mind that the 5% discount is not on the entire $1,000. It's on the $1,000 minus the $100 that we already returned. So we only owe 5% of $900 or $45. How much cash are we going to pay? We're going to pay $900, which is how much we owe, minus the 45 discount for a total of $855. Now let's go ahead and record this amount. We know that $855 is paid in cash, so we are going to credit the cash account for $855 on the 17th. Then we know that once we pay this $855, we will not owe anything on the accounts payable. So to bring the accounts payable balance to zero, we have to debit $900 to accounts payable. We have $900 debit, $855 credit. The difference is a $45 discount. What do we do with the discount? The discount amount gets credited to the inventory account, and then it reduces the cost of your inventory. There are two new terms that you need to know. One was purchase returns, which we just talked about. This is where the item is returned and we, the company, don't need to pay for those goods. However, there's another term which is called an allowance. When it's an allowance, the buyer keeps the item for resale, but the vendor gives an allowance for damages or inconvenience. In both cases, the amount is treated identically. So the allowance or the amount of the return reduces the value of the inventory account and also reduces the amount that we have to pay the vendor. If it is a purchase return, we physically return the inventory item to the vendor. But if it's an allowance, we keep the item, but we get a discount or we get a reduction in price, and we have the item physically in our possession. Either way, the accounting treatment for returns and allowances are identical.